In this episode, Mark Hafner, President and CEO of Celtic Capital, and Alex Fallow, Executive Vice President and Chief Credit Officer, discuss the pros and cons of different ways to finance your business.
So business owners need to be aware of the different options they have in financing their business. And so we thought we'd talk about some of the pros and cons of each. The most common method of financing your business is with a bank. And that's what most people think about when they are seeking capital. Banks have a lot of pros and cons to them. Obviously, there's a lot of different options of banks all over in every city, every state. And they're typically the low-cost provider. Their interest rates are cheaper, and so that's a benefit to the borrower. They'll sometimes have an open line of credit. Other times they're advancing against specific asset classes. So there's a lot of different options there available. Some of the negatives, however, are their approval time and their process takes a lot longer than other types of lenders, partly because they're regulated, and they are more tightly controlled. So the borrowers have to comply with different types of covenants in their loan agreements, and sometimes they have to manage their businesses to those covenants. And those covenants are typically directed towards the financial performance of the borrowers. Another option, if you don't qualify for bank financing, is asset-based lending. Asset-based lending provides a quicker turnaround time, a quicker closing to the funding, and they're typically more flexible in their loan structure. Asset-based lenders advance against several different types of asset classes, accounts receivable, inventory, equipment, real estate, what have you. And so there are more options sometimes for the borrower. The negative to an asset-based lender is costs are typically higher than the banks, but that depends on the size of the borrowing.
Yeah, Mark, I think I'd add as well, the biggest difference between an asset-based lender and a bank is when a borrower is in a difficult situation, where banks are limited in terms of their ability to restructure a facility to help the borrower, whereas an asset-based lender has much more flexibility to do so. And also, in an asset-based lending facility, the lender tends to help the borrower institute disciplines in their accounting. And so that helps, obviously, for the future as they move on to a bank.
Good points. Thank you. The next category we thought we'd cover was factoring. Factoring is somewhat similar to asset-based lending, but there are differences. Factors typically only lend against accounts receivable, not other types of asset classes, so it's more limited, but they can offer more aggressive advance rates, and they look at debtor concentrations differently. So if the borrower has a large customer, the factor will be more lenient on that than perhaps an asset-based lender would. Some of the negatives are the factors are typically higher costs than an asset-based lender and obviously a bank as well. They also may notify account debtors. That means that the factor sends a letter to the customer of the borrower and requires the customer to pay the factor directly. And oftentimes business owners don't appreciate that.
Yeah, I think factoring is much more intrusive than asset-based lending or bank lending in that many times the factor will want to contact the customer prior to advancing on a sale. And as you may have mentioned, the factor is also handling collections. So the borrower really loses control of their receivables to the factor.
Another option for borrowers to borrow funds from are merchant cash advance lenders, or called MCAs. These have become prevalent in the last 5 to 10 years, and they're all over the place, and different MCA lenders have different requirements. One of the pros is they're very quick. So they're 24 to 72 hours. Typically, you can have money in your bank account, and that's very advantageous if borrowers are up against a tight time frame. But there are a lot of negatives. They have a very aggressive payback schedule. It's typically daily, weekly, occasionally monthly, where they're pulling funds directly out of the borrower's bank account. It's extremely expensive. It could be anywhere from 50 to 200%, and it's a very quick payback structure. So these daily, weekly payments are set up so that the whole loan, not only what was borrowed, but the fees incurred, is paid back in anywhere from 9 to 18 months. So they should only be used in specific circumstances where the borrower has the ability to repay that. Otherwise, they just get in deeper, and it's a disadvantage to the borrower. It really ties up the future cash flow of the borrower because all these funds are being pulled directly out of their bank account.
And Mark, I would also add that the MCA lenders are extremely aggressive if you get into a default situation. Most of the times, the security of an MCA is implied, meaning a UCC filing is not done. But you can bet that as soon as you're in a default situation, not only are your payments going to double, sometimes triple, but they will begin action sooner rather than later.
Another option for borrowers is to bring in subordinated debt, and this would be debt subordinated to the senior lender so that if they have a bank line in place and that's not providing sufficient capital, they borrow subordinated debt so the money can't be repaid until the bank is repaid. Some of the advantages are the subdebt typically has a longer term payback. It's not fluctuating like a revolving line of credit might be, and so that can be more advantageous. So it gives them a little more flexibility. The cost-wise can vary, so it depends on who they're borrowing from. Oftentimes, small businesses borrow subordinated debt from family and friends and negotiate whatever cost is involved, but larger institutions that provide subordinated debt may be a mid-range cost-wise between a bank and an asset-based lender or factor. So there's different pros and cons there, and borrowers may have the ability to bring some subordinated debt in. They may not, depending on what their contacts are. And the last type of financing for your business that we thought we'd touch on today is equity. And obviously, equity doesn't have an interest expense, but it has a long-term expense where you're giving up part of your business. So if you're the borrower and you bring in equity, you're giving up a percentage of your business permanently. It may be a minority portion, may be a majority. Just depends on what is negotiated and how much money comes in. And you really have to be on the same page because they're a partner in your business. Whether they're operating the company with you or just providing the funds, they are a partner, and you better be on the same page or it can lead to disruption in the business, especially in terms of the exit plan. Does your equity partner expect to exit and get paid back in a certain period of time? And does that line up with your own expectations?
And I think some of the reasons for bringing equity in don't just have to do with financial conditions. It could be that you bring in someone that has an expertise that you don't, and you offer equity as a carrot in order to bring someone in and increase the prospects of success in your business.
Yeah, or it may be that you're bringing it in because you have the option to merge or acquire another business or expand your existing business, so there may be benefits there.
Thank you for listening today. If you'd like to talk to Mark Hafner about your specific business financing issue or about making referrals to Celtic Capital, sign up for a quick one-on-one chat with him at www.celticcapital.com. And if you haven't already done so, subscribe to our podcast channel to hear more business financing insights from Celtic Capital.